The year is 1991, and across the globe, banking regulators are simultaneously shutting down what was once the seventh largest private bank in the world. In London, New York, Luxembourg, and dozens of other financial centers, investigators are seizing records, freezing assets, and uncovering what would become known as the greatest banking fraud in history. The Bank of Credit and Commerce International, better known by its sinister nickname, the Bank of Crooks and Criminals International, didn't just fail as a business. It collapsed under the weight of systematic corruption so vast and intricate that it would take investigators years to fully comprehend the scope of its criminal operations. For 2 decades, BCCI had operated as a financial supermarket for the world's most dangerous criminals, dictators, terrorists, and drug cartels, all while presenting itself as a respectable institution serving the banking needs of developing nations. The bank's collapse would expose money laundering operations that spanned continents, bribery schemes that reached the highest levels of government, and a web of financial crime so sophisticated that it redefined how the world understood international banking corruption. When the dust settled, over 1 million depositors had lost their life savings. Entire governments faced financial crises, and the global banking system was forced to confront uncomfortable truths about regulatory oversight and international financial crime. The story of BCCI begins in 1972 with Agha Hasan Abedi, a charismatic Pakistani banker with grand ambitions and flexible morals. Abedi had previously built United Bank Limited into Pakistan's second-largest bank before political changes forced him to seek opportunities elsewhere. His vision for BCCI was revolutionary for its time, a bank that would serve the developing world, particularly Muslim countries, with the same sophistication and global reach as established Western institutions. Abedi structured BCCI as a holding company incorporated in Luxembourg with operating subsidiaries around the world, a complex arrangement that would later prove crucial to its criminal operations by making regulatory oversight nearly impossible. The bank's early investors included some of the wealthiest individuals in the Middle East, most notably Sheikh Zayed bin Sultan Al Nahyan of Abu Dhabi, who would eventually become BCCI's largest shareholder with a 77% stake. From its headquarters in London's fashionable Leadenhall Street, BCCI began an aggressive expansion that would see it operating in 73 countries with over 400 branches within 2 decades. The bank cultivated an image of respectability and third-world solidarity, marketing itself as an institution that understood the unique needs of developing nations and immigrant communities in Western countries. Abedi was a master networker who cultivated relationships with powerful politicians, intelligence operatives, and business leaders around the world, using the bank's resources to curry favor and buy influence. By 1975, BCCI had already established a presence in London and began targeting wealthy Middle Eastern clients, many of whom were attracted by the bank's promise of discretion and its understanding of Islamic banking principles. What made BCCI particularly dangerous was how it weaponized the complexities of international banking regulation to create a criminal enterprise that operated in plain sight. The bank's corporate structure was deliberately designed to exploit gaps between national regulatory systems, with the Luxembourg holding company owning subsidiaries that were incorporated and regulated separately in each country where BCCI operated. This meant that no single regulator had complete oversight of BCCI's global operations, and information sharing between international banking authorities was limited and slow. The bank maintained 2 sets of books for nearly every transaction, with legitimate business mixed seamlessly with criminal activity in a way that made detection extremely difficult. BCCI's auditors, the prestigious firm Price Waterhouse, would later admit that the bank's structure made it nearly impossible to conduct meaningful oversight, as they were only able to audit individual subsidiaries rather than the institution as a whole. The bank exploited time zone differences and regulatory gaps to move money rapidly around the world, often completing complex transactions across multiple jurisdictions before any single regulator could intervene. Internal bank documents later revealed that BCCI maintained detailed files on regulators, politicians, and law enforcement officials around the world, using this intelligence to stay one step ahead of investigations and to identify officials who might be susceptible to corruption. The bank's London operations were particularly important to its criminal activities, as the City of London's light-touch regulatory approach and sophisticated financial infrastructure made it an ideal base for international money laundering operations. The scope of BCCI's criminal clientele reads like a rogues gallery of international villainy, encompassing dictators, terrorists, arms dealers, and drug cartels from every corner of the globe. The bank provided extensive financial services to Manuel Noriega, the Panamanian dictator, helping him launder millions of dollars in drug money and bribes while he served as a CIA asset during the Cold War. BCCI maintained secret accounts for Saddam Hussein's government, helping Iraq circumvent international sanctions and finance weapons purchases during its war with Iran in the 1980s. The bank laundered money for the Medellin cartel, including funds belonging to Pablo Escobar, and provided financial services to other major drug trafficking organizations throughout Latin America and Asia. Abu Nidal, one of the world's most notorious terrorists, maintained accounts at BCCI and used the bank's services to finance attacks across Europe and the Middle East. The bank served as a financial conduit for arms dealers supplying weapons to conflicts in Africa, Central America, and the Middle East, often facilitating transactions that violated international arms embargoes. BCCI's client list included Ferdinand Marcos of the Philippines, who used the bank to hide billions of dollars stolen from his country's treasury, and other corrupt leaders from across the developing world. The bank provided services to intelligence agencies from multiple countries, including the CIA, Pakistani intelligence, and various Middle Eastern security services, often facilitating covert operations and off-the-books activities that governments wanted to keep hidden from their own oversight bodies. This web of criminal and intelligence relationships made BCCI incredibly valuable to powerful interests around the world, which helps explain how it operated with impunity for so long. The bank's money laundering operations were sophisticated beyond anything law enforcement had previously encountered, utilizing cutting-edge technology and financial instruments to move dirty money across the global banking system. BCCI pioneered the use of computerized wire transfer systems to rapidly move funds between its branches, often completing complex multi-jurisdictional transactions within hours. The bank created an intricate network of shell companies, nominee accounts, and offshore entities that made it nearly impossible to trace the true ownership of funds or the ultimate destination of transferred money. Bank officials would regularly accept suitcases full of cash at branches around the world, particularly in Miami, London, and Panama, converting these funds into wire transfers or cashier's checks that entered the legitimate banking system. BCCI developed special procedures for handling what it internally called special clients, which included providing false documentation, creating fictional loan arrangements to justify large cash deposits, and maintaining parallel accounting systems that hid the true nature of transactions. The bank's Miami operations were particularly important to its drug money laundering activities, with investigators later determining that BCCI processed hundreds of millions of dollars in cartel proceeds through its Florida branches. Bank employees were trained in counter-surveillance techniques and were instructed to report any unusual interest from law enforcement or regulatory authorities to senior management. The bank maintained safe deposit boxes in multiple countries containing cash, gold, and sensitive documents that could be accessed without leaving traditional audit trails. Perhaps the most shocking aspect of BCCI's operations was how deeply the bank had penetrated the American financial system and political establishment, despite never receiving formal regulatory approval to operate as a bank in the United States. Through a complex web of proxy investors and shell companies, BCCI secretly gained control of several American banks, including First American Bankshares, which operated branches in Washington, D.C., Virginia, and Maryland. The scheme to acquire First American involved BCCI providing secret financing to a group of prominent American investors, including lawyer Clark Clifford and his partner Robert Altman, who served as fronts while BCCI maintained actual control of the institution. Clifford, a former U.S. Secretary of Defense and advisor to multiple presidents, became chairman of First American and received millions of dollars in compensation and stock profits, later claiming he was unaware of BCCI's hidden ownership. The acquisition gave BCCI access to the American banking system and allowed it to process transactions that would have been impossible through its foreign branches. BCCI also secretly acquired Independence Bank of Los Angeles and had investments in other American financial institutions, creating a hidden network that processed billions of dollars in suspicious transactions. The bank cultivated relationships with prominent American politicians from both parties, making strategic campaign contributions and hiring well-connected lobbyists to protect its interests in Washington. Bank records later revealed that BCCI maintained detailed intelligence files on American political figures and used this information to identify potential allies and targets for corruption. The depth of BCCI's American operations shocked investigators and led to extensive congressional hearings that revealed troubling gaps in banking oversight and regulation. The beginning of BCCI's end came in 1988 when a joint investigation by U.S. Customs and the Drug Enforcement Administration, known as Operation Sea Chase, successfully infiltrated the bank's money laundering operations in Florida. Undercover agents, led by Customs investigator Robert Mazur, posed as money launderers seeking to place drug proceeds into the banking system and found BCCI officials eager to assist with their illegal activities. The investigation culminated in dramatic arrests during a fake wedding ceremony in Tampa, where BCCI officials and other co-conspirators were taken into custody while celebrating what they believed was the marriage of two major drug money launderers. The resulting trials exposed BCCI's systematic money laundering activities and resulted in guilty pleas from several bank officials. But this was just the tip of the iceberg. As investigators dug deeper into BCCI's operations, they discovered that money laundering for drug cartels was only one aspect of a much larger criminal enterprise. The bank's own internal audits, which were later leaked to regulators, revealed massive fraud, including billions of dollars in unrecorded deposits and fake loans that existed only on paper. Price Waterhouse, BCCI's auditor, conducted a special investigation that uncovered systematic fraud dating back to the bank's earliest days, including the creation of fictional assets and the manipulation of financial statements to hide losses. As word of the investigation spread, wealthy depositors began withdrawing their funds, creating a liquidity crisis that made it impossible for BCCI to continue operating normally. The bank's situation was further complicated by the fact that much of its apparent assets were either fictional or represented loans to entities controlled by the bank itself, meaning that BCCI was essentially insolvent and had been for years. The final collapse came with shocking suddenness on July 5, 1991, when banking regulators in multiple countries simultaneously seized BCCI's assets and shut down its operations worldwide. The coordinated action, known as Black Friday in the banking world, was the result of months of secret planning by international regulators who had finally grasped the full scope of BCCI's criminal activities. In London, investigators sealed the bank's headquarters and began the massive task of sorting through decades of fraudulent records and hidden transactions. Similar scenes played out in New York, where state banking officials shut down BCCI's American operations, and in dozens of other countries where the bank had maintained branches and subsidiaries. The immediate impact was catastrophic for BCCI's more than 1 million depositors, many of whom were immigrant workers and small businesses in developing countries who had trusted the bank with their life savings. In the United Kingdom alone, over 120,000 depositors lost access to their funds, with many facing financial ruin as a result of the bank's collapse. The closure revealed that BCCI had been operating essentially as a Ponzi scheme for years, using new deposits to cover withdrawals, while bank officials diverted billions of dollars to their own accounts and to finance criminal activities. Investigators eventually determined that the total amount missing from BCCI exceeded $12 billion, making it the largest bank fraud in history at that time. The bank's collapse also created diplomatic crises, as several developing nations had maintained substantial deposits at BCCI and found themselves facing severe budget shortfalls when their funds disappeared. The government of Bangladesh alone lost over $100 million, while dozens of other countries and international organizations discovered that funds they thought were safely deposited had vanished along with the bank. The aftermath of BCCI's collapse reverberated through the international financial system for years, leading to major reforms in banking regulation and oversight that continue to shape the industry today. Congressional investigations led by Senator John Kerry revealed the extent to which American law enforcement and intelligence agencies had been aware of BCCI's criminal activities, but had failed to take action due to the bank's usefulness in funding covert operations during the Cold War. The scandal led to significant changes in American banking law, including requirements for greater disclosure of bank ownership and enhanced penalties for money laundering. International cooperation on banking oversight was strengthened, with new agreements on information sharing between regulators and enhanced procedures for monitoring cross-border banking activities. The collapse also exposed the inadequacy of existing auditing standards for international banks, leading to new requirements for comprehensive global audits and greater accountability for accounting firms. Several major trials followed the collapse, with BCCI's founder Agha Hasan Abedi dying before he could be prosecuted, while other senior bank officials received prison sentences in multiple countries. Clark Clifford and Robert Altman were indicted for their roles in BCCI's secret acquisition of American banks, though Clifford was deemed too ill to stand trial, and Altman was ultimately acquitted. The legal proceedings revealed that BCCI had paid bribes to officials in dozens of countries and had maintained a global network of corruption that reached the highest levels of government and business in many nations. Recovery efforts for depositors were largely unsuccessful, with liquidators able to return only a small percentage of lost funds despite years of effort to trace and recover BCCI's hidden assets. The scandal permanently changed how regulators and law enforcement agencies approach international banking crime, leading to the development of new investigative techniques and international cooperation mechanisms that remain in use today. The legacy of BCCI extends far beyond its immediate victims, serving as a cautionary tale about the dangers of inadequately regulated international banking and the ease with which sophisticated criminal organizations can exploit the global financial system. The bank's operations demonstrated how legitimate financial institutions could be weaponized to facilitate virtually every form of international crime, from drug trafficking and terrorism to arms dealing and political corruption. BCCI's success in operating undetected for 2 decades revealed fundamental flaws in the international regulatory system that allowed criminals to exploit gaps between national jurisdictions and the lack of effective cooperation between regulatory authorities. The scandal showed how easily the banking system could be manipulated by individuals with sufficient resources and connections, particularly when they were willing to provide services to intelligence agencies and other government entities that preferred not to ask too many questions about the source of funds. The BCCI case became a template for understanding how modern financial crime operates, inspiring new approaches to investigating money laundering and international fraud that recognize the interconnected nature of global criminal networks. The bank's collapse also highlighted the vulnerability of immigrant communities and developing nations to financial predators who exploit cultural connections and promises of solidarity to gain trust and access to victims' resources. Many of the techniques pioneered by BCCI, including the use of complex corporate structures to hide beneficial ownership and the manipulation of time zone differences to complicate investigations, continue to be used by criminal organizations today. The scandal remains a touchstone for discussions about banking reform and international financial crime, regularly cited by policymakers and law enforcement officials as an example of what can happen when oversight fails and criminal organizations are allowed to operate with impunity within the global financial system.